Hello, my name is Bob Plucker and I'm a realtor up in Wisconsin. Often first-time home buyers or someone buying a house ask me the question, how much house can I afford? Well, this is how I answer that question, and it'll give you an opportunity to figure out exactly how much house you can afford and are comfortable with. So I'm going to make a couple of assumptions. The first assumption is that you want to use a lender for your loan for your home or your mortgage. And the second assumption is you'd like to preserve as much cash as possible after the closing, so there's going to be a minimum down payment on your house. Now, what I'm trying to do in this video is to just give you basic lender guidelines, what the bank needs from you. Now, lenders are concerned basically with your income and your debts, and that's how they're going to determine how much house payment you can afford, which determines how much house you can actually buy. So let's go to the income side. The bank is concerned with your gross monthly income before taxes, and this includes your wages, overtime, child support, whatever revenue sources are coming into your household. The lender is going to want to know the gross. So I'd rather do an example, and then I can just show you how much easier it is to understand. So in an example, let's say your gross monthly income is $600 a month. If you take, or $600 a week, excuse me. $600 times 52 weeks a year is $31,200 a year. Divide that by 12 months, so your gross monthly income is $2,600. And the lenders actually have two magic numbers for determining what you can afford on a house. The first magic number is 28%. You take 28% times your gross monthly income, and in this case, $2,600 times 28% is $728 per month that you could have towards your house payment. Well, in your house payment, there's actually 5 components. There could be more than that, but we'll just talk about the 5 most common components. The first one is principal, and the second is interest. Now that goes to the bank to cover the loan. The third is the taxes, the property taxes on the house. The fourth is the insurance payment for your fire insurance, theft, those kind of things on your house. And the last is private mortgage insurance, or PMI, and I'll talk about that a little later. In this example, if you had $728 available for your house payment, in my market, I just used a $100,000 house as a purchase price for the home that you'd like to buy. At $100,000, the lowest down payment that's easily attainable is under FHA financing or federal housing, and that requires a 3.5% down payment. $100,000, 3.5%, so it's $3,500 for your down payment towards the house. That would mean that your loan amount is $96,500. Well, in today's market, I'm using, in this example, 4% interest on the loan, and I'm amortizing it or spreading the loan out over 30 years. Well, 4% interest, 30 years, $96,500, your actual house payment for principal and interest is $460 a month. In Wisconsin, our property taxes are pretty strong. On a $100,000 house, the property tax is $1,800 a year. Divide that by 12 is $150 a month, so add that to the $460. The next is insurance, and in our area, insurance is about $600 a year on a $100,000 house. So divide that by 12, $50 a month. So your house payment is the $460, $150 for the taxes, $50 for the insurance, and you come up with a $660 monthly house payment. But because you don't have a 20% equity position, or the loan is more than 80% of the value of the house, the lenders are going to require PMI or private mortgage insurance. And I'll give you a worst case scenario. Because you've only put 3.5% down, that's a pretty high uncovered portion of the loan between the 80 and the 100%. So in that scenario, the worst case, PMI is going to run you $65 per month per $100,000. If you have a bigger down payment, the PMI is going to be less as a percentage, but you can, I'm giving you the worst so you can have an idea of what that PMI is going to run. So if you add the $65 in PMI onto the $660, your house payment is $725, and going back up to our example, you have $2,600 in gross monthly income times 28%, the lender's number, came up $728. Your house payment would be $725. You'd qualify under the first magic number the lender uses. Now there's a second magic number the lender uses. Go back to your gross monthly income. In our example, $2,600 times 36%. 36% is your house payment plus your credit cards plus your car payment plus any monthly payment that you make that is a non-living expense. Anything you've got on a monthly payment goes into that 36%. So in our example, if you take $2,600 times 36%, that's $936 a month. Subtract your $725 house payment, and that leaves you with $211 per month left for your car payment, credit cards, whatever. If you qualify under the 28% and the 36%, you're good to go. Now, what if I don't qualify under the 36%? I've just got too many credit cards. You have a couple of options. You can pay things off over time, get rid of that extra, and build yourself up to that house that you want to buy. Or you're going to have to deduct that difference from your 28% and have a house payment that is less than 28% of your gross, so that you're still under the 36 for your overall monthly payment schedule. It doesn't disqualify you if your monthly payments on your monthly bills are greater than the 36% using a 28, but if you need to bring that down to a 36%, which is consequently going to lower what you can afford for your house payment. Your house payment may come all the way down to 20%, and it all depends on your lifestyle. Hope this helps. I will be doing more videos. If you have any questions or comments, please submit them. Once again, my name is Bob, and we'll see you next time.